and let's jump in. We got two back tests to look at today. I'm gonna let you share your screen and just drive.
Yeah. So I think this is the theme that, you guys give me a back test that I probably won't like.
Yep.
So with this one, I mean, kind of rule of thumb is like we want three mechanics. That's basically a sizing mechanic. You want a risk mechanic, which is basically when you're taking the trade-off, or that can be the sizing. And with your entry mechanic, it could be like a specific time. And then you basically want also some types of exit mechanic, which can be a combination of those all. And then filters basically will reduce your credibility by half and double your drawdown in my mind. So like if we already look at this, we have two filters on entry and two filters on exit. So I would say in actual reality, I would expect this to be 1/6 the return. So like an 11% return. And I would expect this drawdown to triple. So that's what I would think it would basically be like. So in the nature of this, it's like, it makes no sense to have a VIX cap. And if you're trying to control for portfolio size, you could just do, a fixed one lot. The only reason I would see people basically doing a VIX cap is that the sizing of, this 20 delta could be big in a higher VIX, but you could just solve for that in the nature of the back test. So like that makes no sense to have. I also don't really like this floating entry time because you're kind of just manufacturing occurrences with all this stuff. So, and then also like this EMA on top of a VIX doesn't really make sense. So to just start beating this up, we're getting rid of the VIX cap. I'll let you have the VIX intraday move, but you don't get the EMA. And we'll see just to start with that. And this is still being generous, like having this, but the reason I chose the VIX up is because, we're a little married to this. So like this is a way to sell puts based on volatility, not direction. If we see these two, so like that can make logical sense, but like this is just basically, curve fit swap. I'd also like to point out that generally people love to curve fit with like asymmetrically large losses. So if these filters can get rid of like the three largest loss days, and then you just have a big left tail that you can basically continue to hold on in here, that's kind of what you would be going for. And then something as simple as this that doesn't have a bunch of occurrences, we should probably also take back to at least 2020 to kind of see what that's doing. And then 30 cents. Okay, this doesn't look too bad for slippage at least. Okay, so again, like, we can kind of get behind this in types of returns. Like I wouldn't have a huge problem with what this is. Also, I don't really see why we're allocating 100% of our portfolio. So this is also kind of leaving us exposed to, potential compounding of risk. So basically, if we have 100% of the portfolio, if you hit a hot streak, it basically is just doubling down on a massive amount of risk. Whereas that's not like, this is one trade and one time slot. It's not something someone would run at 100% of our portfolio. So this is like massively skewing the potential returns. And then if the slippage is slightly off, you're also doing you the courtesy of like multiplying that rosier picture by like 100,000 occurrences and contracts, which will make it even more realistic than that. So like those basics of back testing in general with like a one lot and then two things. So, you can see here the MAR went down a little bit from just having a fixed contract size. So you're not benefiting from like a hot streak of compounding, but newsflash, it would also hurt you on the reverse side as well. So like, that's not how you want to test. So this, I think this is pretty, I don't have a huge problem with actually trading this now that we have it. Like the VIX move makes sense to me. The only thing that I think is a little rosy here, and you can correct me if not, Troy, but I believe this VIX parameter updates on the minute basis. So, we may have a little bit understatement of losses in terms of occurrence and what that actually looks like in actuality. So I would have to push this to a forward test to see if we can actually believe this. But when we start to look at like all these entry requirements and such, I would be really curious if we literally just sold a put with nothing. Let's exit. We'll keep this minus 2.2. So this would just be selling. Redo this. So now if we got rid of all the filters basically and just sold a put, what would that now look like? I guess since we don't need the VIX up, we could just do a couple times. So, now we'll kind of see what this looks like because we may get a 10% PCR with, just entering this with no basically VIX parameters. So that would kind of just show if it's like a null hypothesis.
A couple things real quick, just for people who, are newer and, obviously we move very fast on this show, and no apologies for that because you can go back and watch it a bunch of times. But when you hear him say like a 0.8, you think, oh, well, that killed my test, right? But you hear what he's saying. It's interesting. It's like, no, you could probably forward test this. This might be fine. And so what is he saying in that? He's saying, like, if you hear the inductive part of that, he's saying, run a bunch of strategies, right? Don't just run one trade. Is that right, Mark?
Yeah. And I mean, everyone wants to get leveraged and feel good about taking risk. That's just not the way to go about it in terms of scale. It's like I would trade like this if I only had 100 grand in my name and I was trading options too, but it's not going to be how you continually trade. And like I talked about this in the last one, but it's like the Sharp of Palantir is 0.8 and the Sharp of the S&P is 0.8. Palantir is obviously up like, 200% or whatever, but and it is a cheaper form of leverage. Like if you want to just own Palantir, I don't necessarily have a huge problem with that, but it's like you can't do that as like a long-term solution for wealth. Like it may work for a year or two, but it's eventually gonna like get you. Okay, so yeah, I'm okay with this. I would just say like take those filters down. I think by having something where you have more occurrences, that's just like maybe it's only above the 12-day EMA. I think was the original component on that thing. Just because it's more frequency. But I do recognize if you have a 100 grand account, you can't tranche 10, 20 delta lots throughout the day. So if you want to throw this on as 10% of your buying power, if you have a 100 grand account, I see no problem with that. I don't like all the filters and everything. And just the theme here is like, this is something I believe you could actually achieve, and basing your sizing off of this would be a good idea, basically. And then the other thing I want to impress on people is it's like, here are your mechanics without the VIX filter. This is, obviously beat up a lot, but like your results will fall in between this and this, which, is like, I think I actually screwed up on the back test allocating 100% because it blew up too quick. So it didn't make occurrences. Sure. So that was bad, but we can do that another time. I like the Apple one here because
so the next one is Apple 7-day RIC. Just real quick for people who don't know what we're looking at here, let me put this in the chat. This is a reverse iron condor, so you want movement. It's the exact opposite of an iron condor where you don't want movement. So go for there.
Other thing, Apple is starting to trade Monday, Wednesdays, and Fridays. So this is going to be a marketplace where I think we will be trading more is individual figures that start to come into play. We probably need a little more back testing data since we've got and we'll base it off of like kind of what's in SPY, but this is where the market's going. So I think this is interesting. In terms of it, like Friday, 7 DTE, profit target 90%. Since it's, not cash settled, we obviously need that. I don't really have any problem with this except for the duration. So, we obviously need to be going further back. Apple has existed for a very long time. I don't know why a strategy this simple would. Also, your guys' allocations need to chill out a little bit.
Yeah,
But
it's free money. It's free money.
yeah, but with this and then 3 cents, yeah, that's probably fine. I don't know too much about Apple and trading and everything. So like the structure of this is just fine. We just have to go further back in time. It really makes no sense why we would only test this environment. So basically we want to exclude like, a huge data set we have for no real reason. And then other good thing about this is since it's a debit trade and we don't have intermittent stop losses for tickers like Apple, I have a large amount of trust in this back test as well. And the other thing too is like you've only chosen one day of the week and you chose a limited yearly time frame and you chose one specific time. So if you're going to choose one specific time, we definitely need to go much further back in time. But I agree with only having it on Friday because you're holding the trade continuously basically through the week. Oh, and look at this. So, yeah. And again,
one trade. It's one open trade. Sorry.
Yeah.
Yeah, you had some occurrences.
So yeah, I probably would not trade this. I like the thought of like Apple and such. Another way we could potentially look at this, since it's a tight spread, is we could just flip it and see how the positive expected value is going. And let's go further back in time as well.
How do you? This is fix my back test, but as a big picture thing, how do you feel about like long gamma trades, Mark? I think people have a sense of you. It's like, oh, he's just doing spreads all day.
I kind of talked about this last week, but if you understand pricing of options, long gamma and long vol trades or debit trades make a lot of sense. So, this one on both sides, I think, is contradicting a little bit because you're buying really deep into put skew and then you're simultaneously like offsetting. You're not really taking much risk. So you're like just buying really expensive skew, which doesn't really make any sense to me. But if you were doing something that was like you were selling similar to like a calendar, like you were, or reverse calendar, I guess, like you were selling, a 2DT and you were buying like a 5, like I definitely think those structures could work. And if you had like a 3 lot here and a 2 lot here, so, buying straight debits like this probably aren't going to work. But if it's structured with like the right amount of long contracts or short contracts, and then you're buying at the money and you're selling out of the money, I think those are actually some of the strongest edges that are out there. They obviously like aren't the prettiest P&L on earth, but you can't blow up with them. And you obviously have a high conviction in the back test because there's no path dependence of like management and such. This doesn't work both ways. Obviously we could probably have a better, mechanic here for managing our risk or whatever, but I would not touch this with a 10-foot pole. So that would just kind of be how I would think about looking at these. And then also, if you're looking at an individual ticker like Apple, the friction of the bid ask and commissions based on the size of the instrument is just going to suck compared to like trading SPY. So I would just, if you have a thesis, like you think that you have an indicator that works, you should always try to exert that in the most liquid, cheapest executional cost instrument possible. Not that Apple is not liquid and cheap of execution, but I think Apple's, roughly $100 a share. So per like putting the contract on, you're taking on like 4 times more slippage and 4 times more commission cost to exert that same thesis, which is probably not a great idea to do such. Another thing in terms of short vol is like, I'm not sure if I believe volatility is overstated in individual underlyings.
Yeah, that's an interesting, man. That's a good talk.
Yeah, like that is something where there's very unprobable things that aren't priced in. The example I really like is like Steve Jobs getting diagnosed with cancer. Like that is not baked into the price whatsoever, but it really changes the company. Or like if Jensen Huang sleeps with a hooker, I don't know if the market would like it or not, but like that, like if you think about it, it's like in like the only real like you can view black swans in two ways. Like I view 9/11 as a true black swan because no one knew about it. Whereas like 2008 could be viewed as a black swan because it was like a 10 standard deviation move. But like we could also see that like the banks were in trouble from a very long ways away. So like the probability of actual black swans occurring in individual names is like very easy. There could be fraud. The CEO could die. One of their providers could be committing fraud or something in regards to that, or the government could particularly single them out for some reason. Whereas like that is not really present with the S&P. So like based on the liquidity perspective and that, I don't think it's attractive. There are very sophisticated people who like cover the news perfectly on Nvidia and Apple that I think can trade vol very well. But like looking at an IV rank or like a VIX handle to tell you should trade Apple based on something is like probably not a good idea. And the other example that I think is really interesting is like people like last year, the crazy move was DeepSeek one with Nvidia, where like they announced that DeepSeek basically doesn't need chips to like reveal stuff. And it's like, if you would have sold put credit spreads in Nvidia, you basically would have taken like 40% drawdowns and like had not made that much money selling puts. Whereas if you would have just owned the underlying, you would have had like none of the stress and you would have made like 400% or something. So that type of stuff with individual names is very dangerous. And like, we go back to the professional vol space, like how most people trade individual names is like, they see a difference in pricing between like Nvidia and S&P, and they basically take an exposure of the volatility between those two. It's called dispersion, like high dispersion or low dispersion. People generally just aren't short volatility with stuff like that. Or if you can read the term structure, certain things can be very lucrative. There's a good video that Chris Abamusia from Moontower AI did on calendars. And basically like if you wanted to do a calendar and you guys have short long ratio on your platform, you want that back duration of that calendar to be pretty steep. If it's flat, like if you have a 30% front month fall and a 35% back month fall, I would want to be short that, irregardless if the VIX is at like 100, because that is just a very strong backward. It's flat, so it's still contango, but there should be, way more contango in that for what you would want to take. And this is a little counterintuitive, is like with calendars, low vol could be some of the best time to trade because the front month could be a 14 vol and the back month could be a 15, which is very strong contango actually. And this is where I think a lot of people screw up when they try to come with their thesis of backtesting, is like the options are priced in a way to where you can basically have, I don't want to say edge, but you can build your system. So people think options are a zero-sum game. And the way I kind of think about it is like there is basically like negative feedback systems and there's positive feedback systems. So 99% of the time, the market and the options market is a negative feedback system. Basically, a market maker will, execute your trade. You're trying to get in that trade because you want exposure to the option. And the market maker is happy to execute that for you. The market maker, in order to be capital efficient, will borrow the share from, let's say, a pension fund. The pension fund gets to keep their long-term holding and gets paid a little bit of borrowing cost. And then the broker on the other side is able to execute everything with, the commissions and fees, and the market maker basically hedges off the risk. This is all a negative feedback system that will not feed back into each other. That's the normal stasis of the market. Volatility will decay. You should make money. And then there becomes basically a positive feedback system, which would kind of be like a nuclear bomb, like heat trips off, which makes more heat, which makes more reactions, and so on and so forth. And this is like a short squeeze, or what happens in times of high volatility. So but the thing is, if you sell an expensive option, let's just say an out of the money option, and you buy an at the money option or further duration, let's say a cheap option. So basically you're going long the most expensive option, and then you're going long the cheapest option, and you're going short the most expensive option. You've essentially created a negative feedback system in that trade. So now you don't need to depend on the market, because if the market doesn't move at all, it will just behave normally. Your long wall will decay, but your short fall should decay faster. You make a little bit of money. And then if we get into a huge volatility event, your short vol will shoot up in price, but your long vol will have all the delta exposure and also continue to get bid up in that long vol environment. So like you can hold that negative feedback system to basically hedge yourself in it and make money in all these environments, even though this is a zero-sum game, because the individual option at a 50 delta that may be priced at a 14 vol is accurately priced. And then the option that may be a 10 delta put that's priced at a 17 vol is also accurately priced. So individually, those, options have a zero-sum game. But since you've built in, this negative feedback mechanism in your structure of your trade, you should make money off of it over time. And again, a calendar is kind of a simplified example of that. Whereas if you add some filter, that's not structural. You didn't get pricing, and I always joke with you guys, and I think you still should put this on there. It's like, we need a stat on Option Omega's amount of babies born in the US on Monday, Tuesday, Wednesday, and Friday, and like a rolling correlation like VIX. And you would be able to see that, like, with that data, you could find some amazing entry points, trade puts or whatever, because there actually needs to be some type of causation that makes sense, because there's a high signal to noise ratio. And the thing is, like, even where we trade in our fund, like, we have what's called vanilla and what's called rules. And it's like, since there's so much noise in intraday trading, we do just tranche the most vanilla things that everyone else does, because you want exposure on. And when you have the rules that come in that are actually good pricing of volatility, like, you're going to increase that, but you need to have positions on, because it lends well to when you layer in more positions that actually have structurally mispriced vol. So I think
that whole thing you just explained, I mean, that's like last year, that was, I look back at my P&L from last year, almost all of the money I made realistically was from like 3 weeks in April during the tariff stuff. And it wasn't because I had a lot of just puts. It was because I had structured previously what you just described with that negative feedback. And it's not about how much money you make, it's about how little it costs to put it on.
Yeah, because in normal times, and I think we're all seeing this, like in the last 3 or 4 months, it's like, you're not really making money trading 0DT or most options. And I mean, this also makes sense because options is a risk transfer market. So if they're not really transferring risk, you're probably not going to make much money. Generally, from the back test, we should make a little more money. But the real thing is, like, we have this spring that's becoming compressed, and like, I'm in like a 1.5% drawdown, even though this has been a very low expected value, like 3 to 6 month period. And like, when it turns around, boom, you're just like into compounding. And that kind of is the nature of how most options will, somewhat behave. But if you're picking one time or having these filters on right now, I'm sure people could be making a lot of money, but you're going to get blown out when we go to a positive feedback system. So I would just encourage people to think, like, do you not lose money with your negative feedback system and hopefully you make a little money with your structure? Or do you just make a bunch of money when we're in negative feedback and then get blown out when we get a positive feedback, like during the tariff periods or whatever? Because I'm opposite.
Yep. That's the exact way to look at it. So Mark, good stuff. I mean, talk about the stuff like that. I just need to rent a giant cabin one day and get smart people like you just to come out and talk to me. But one day,
so my thing that I think we should do that's actually easier is, like, you get the hotel conference room at a really big, cheap, popular airport like DFW or Chicago. And flies in at like 8 a.m.
Oh, that's super smart.
8-hour meeting, and then everyone doesn't have to sleep the night and get back on their Chicago flight to wherever they're going.
Yeah, I'll see you at FLL. That's the way to do it. So, all right. Well, Mark, have a good rest of the trading day, guys. Appreciate you, and we'll be back next week.